Good afternoon, everyone. Welcome to today's option market recap for June 23rd. This is your host, Nathan Peterson, and back by popular demand, but also a frequent guest, Mr. Randy Frederick, Vice President of Trading and Derivatives. Randy, how's your Tuesday going?
Just another crazy Tuesday like every week, but no, actually things are fairly calm today. It's not quite as volatile as we've seen recently, but I'm happy to be back on with you, Nate.
Well, happy to have you on. Yeah, yeah, of course. I mean, this market, there's no shortage of topics to talk about. So, guys, let's just go ahead and hop into it. We'll get to the disclosures here. Keep in mind, Randy and I are going to be talking about options. Options are a different product than stock. They do have risks that you won't find in stocks. You are not a shareholder. You do not have voting rights. All options have an expiration date. With long options, you could lose 100% of the funds invested. For these types of risks and more, just please scroll down to your disclosures, click on that document, or if you can call us at 1-800-435-4000 to get a copy. If your option's approved, you've already received that. Also, Randy and I will be discussing some technical analysis. Schwab does not condone that as your sole means of investment decision making. And probably more importantly, Randy and I have a lot to say about the markets. We're going to be covering a lot of individual securities, commenting on some charts, some of the activity, talking strategy. Going to be taking your questions. We're here to help. We're here to educate. We're here to provide our opinions, but please don't construe them as a recommendation. Two other things, keep those questions coming in. We love to hear from you guys, to know what's on your mind. And then lastly, there's an HD icon in the bottom right-hand corner of your screen. If you click on that, you get some crisper resolution on your charts. Randy and I are going to start at the top, look at what's moving the markets. For the most part, last I saw, holding on to a lot of the gains. Once again, seeing that strength in technology. Then we'll go into some of the activity today. We've got a pretty interesting multi-leg trade that we can discuss today and go through. Maybe that will elicit some more questions from you guys, for you spread traders or multi-leg traders out there. And then along the way, of course, Randy and I will provide commentary on all of that. Okay, so Randy, here we are. NASDAQ, I think, was up 150-ish earlier, as well as the Dow and the S&P. So not at the highs of the day. I don't know. Do you want to talk about the NASDAQ first? This seems to be the standout these days, the markets. What are your thoughts?
Yeah, without a doubt. I mean, if you look at it on a year-to-date basis, the Nasdaq is definitely the standout with regard to the other three major indices, that being the S&P, the Dow, and the Russell. And it's up over 10% year-to-date, whereas the others are all negative. And the worst one, of course, is the Russell. So yes, it's been an outperformer. Part of the reason, of course, are those big FANG stocks and others that are technology stocks. A lot of the FANGs are not technically tech stocks, but we think of them as such. So like, for example, Amazon is a consumer discretionary stock, but people think of it more as a technology stock, whereas Facebook is in communication services. But we kind of see them all as big tech companies. And really, it's technology is obviously the engine behind what makes them do what they do. But those guys are all NASDAQ members. And as a result, when the market starts to perform well, technology had been the leader for the almost the entirety of the 12-year bull market that we just ended. And then when we recovered from the shortest bear market in history, of course, the technology stocks took over, and they've been the leader ever since. And that's what's driving the market higher. So it makes sense that the NASDAQ would be an outperformer. It continues to be quite strong, and I think it's surprised many in the investing and forecasting analyst community that it's done as well as it has.
Yeah, and no doubt. And so certainly there's that momentum that's there. I don't know how much speculative activity is in these types of names. When I see it happen on those smaller cap, those small float stocks, then I can pretty much reasonably ascertain that, hey, that's some speculative activity that's going on there. Here, it just seems to be that's where the money wants to flow. I mean, these are mega cap stocks and everything that's really kind of pushing them up. And Randy, is it surprising to you to see that we are seeing some of the uptick there? And now we had some good news. We had some good PMI data. We had some the housing data has been relatively good there. But is it surprising to you when we see these uptick in the number of cases that we're seeing across multiple states? We're here in Texas and Austin. We're almost considered a hotspot now, or moving in that direction. Is it surprising to you to see the market just continue to pursue higher
Well, a little bit, but I would say again, these tech stocks are benefiting from a couple of things. Again, tech and FANG in specific, because while they sort of have always seen themselves as essential to the economy, it wasn't until we all got stuck at home because we couldn't go to the office any longer that we realized that they are. I mean, you're using technology to link up to all of your coworkers. You're using the internet, and you're using the remote connections and all these things that are all run and driven by these tech companies. And then you're buying your stuff from online retailers and things like that. So in some ways, they have become essential. The way they've always viewed themselves, we now see them as that way. And I've said many times, if this pandemic had happened even as recently as just 5 years ago, I don't think we would have done as well as we're doing right now. And in fact, we're not quite really where we need to be, but it's good enough that we can make things work. And so I think that's part of the issue. Another issue that's benefiting is that you're right. While there's not as much speculation in a stock that's trading at, say, over $1,000 a share, a lot of brokers, Schwab included, have made it easier for people to invest in these companies by allowing them to buy fractional shares. So there is a little bit more of a retail participation than there once was. So I think those two things, those two factors, have been contributing. They're not the whole story, but I think they're part of it. And as the virus continues to uptick, and you see areas of the country start to open up, or others where it's getting worse, like you said here in Texas, that just means we may be at home a little bit longer, and we'll continue to rely on these companies. So to some extent, that's not that surprising from that perspective.
Yeah. No, I hear you on that, and I do think that the situation has definitely pulled forward a lot of that. If you were on the fence about doing any kind of, investment in technology or cloud, et cetera, this probably pushed you over the fence to say, okay, let's go ahead and let's get on board. I mean, we have to, we can't wait any longer.
Yeah, I mean, if the virus did anything, it's forced everyone to sort of look at the ability for people to work remotely and to connect remotely and to do all these things that we have sort of been playing around with. It sort of forced us into testing that all out, and we had to make it work because we didn't have any business goes under. So everybody figured out how to make it work, and it didn't do things that we wouldn't have eventually done, but it accelerated, I believe, and brought it all a lot closer.
Yeah, agreed. Okay, I will point out, and this kind of caught my eye, Randy, is that looking at the S&P, there's been talk about, like, hey, is this an island top up here? We had this big gap up, and then the gap down. A couple weeks ago, we had that after the Fed meeting, basically a 7% decline. And we still haven't gotten back up to kind of close that gap. So I'd keep an eye on that. And the other thing that catches my eye, Randy, is the Dow here just bumping up against the 200-day. So I don't know, right now, I just kind of feel like technology or the NASDAQ might be put into a different category rather than the S&P and the Dow. I don't know, what do you think about that?
Yeah, I do think that's true. And in fact, I had a discussion with a reporter just a few days ago about sometime mid last week about that island top. And it's like a lot of technical indicators. It looks like it could be a turning point sometimes, but if you go back, like you said, on the S&P back to June 4th, we had an island top there, and then next thing you know, we gapped up, and it isn't until just till 2 weeks later that we actually came back down and filled that. So it did not become a reversal at that point. And so it doesn't always work. And
right.
I think technicals are, I've always said that I think technicals, you can't ignore them because there are too many people who watch them closely, but at the same time, you shouldn't rely on them 100%. As you said in the disclaimer at the beginning, it should be a piece of a much broader program, a much broader plan for how you invest.
Yeah, absolutely. And, I think it's a good thing to point out, just, we definitely cover technicals on this show. And if you go to Charting the Markets, and we're talking more in terms of the tactical investing and, that short-term swing trading, charting out the next move. Randy, you do a weekly blog. I know you look at some of those things as well, because if you're just forecasting for 1 week, those technicals can have more emphasis. When we're talking long-term, that's kind of a different conversation.
Exactly right. Yeah. Mm-hmm.
Okay. Well, let's go through some of the, I'll just say real quick on the upgrades and downgrades, and then we'll move into the activity. And guys, if you have any questions or if there's any sector you want us to take a look at, we're happy to do so. Apple, new all-time high, $400 price target coming from UBS. I think they got another $400 plus price target the other day. Not too unusual. Fastenal, they got upgraded to neutral from underweight. And we've got NuVasive, medical device maker here. They were upgraded by Needham, and they've got a $74 price target there. On Semiconductor also received an upgrade going to Piper Sandler. They went to overweight from neutral, price target 24 from 17. Taking a look at the stocks, they are stalling out just a little bit in my mind here, so I just keep an eye on that. Nothing wrong with the chart at all, but just to keep an eye on, it looks like a little bit of congestion here. So I would just say the NASDAQ looks better than the stocks in my mind. I will point out Micron did get a downgrade. Looks like BMO Capital Markets, they went to market perform from outperform. And the other big downgrade was Spirit AeroSystems. Boeing had asked them to reduce their orders here due to decreased demand. And so Berenberg downgraded them to hold from buy and put a $25 price target. I don't know, Randy, I don't think I've asked you this. Do you have any comments or any thoughts about like the whole airline industry? You can throw Boeing and Spirit into that conversation. Any thoughts on that?
Yeah, I mean, I think everybody knows the infamous story recently about Warren Buffett talking about selling out of all of his airline shares. If you're thinking about it in the near term, it kind of makes some sense. I mean, I would argue that it's probably a good 12 months, if not 18 or 24 months into the future before airline traffic gets back to where it was pre-virus. Will it improve? Sure. In fact, the data and the charts will show that seating capacity and flights and the number of people going through TSA are on the upswing, but we're coming from an extreme low level where traffic dropped off 75 to even 90% in some cases. So yes, the trend is in the right direction, and that's a good thing. And it's actually the trend of that and all the other economic data and everything else is on an improving path for the most part, which is partly why the market has moved higher. But if you look at it on a relative basis to pre-virus, we're a long ways off from where that's going to be. So clearly, if air traffic is down, even if it's improving, then the airlines won't be buying as many planes. Boeing won't be delivering as many planes, and Boeing contractors such as Spirit AeroSystems, who makes fuselages, are not going to be delivering as many parts. So it kind of all makes sense. It's just it's a trickle effect that goes on down the line.
Yeah, definitely. And it's not guys, I would, on the airlines, I mean, from a technical perspective, looks like a little bit of a cup and handle here. So you would just keep an eye on basically the top of this, it happened to coincide with the 100-day here for something like a Delta. The chart pattern's different on a number of these, but maybe you keep an eye on that, getting decreasing volume on the handle. But again, you would want to see, if you want it to be a bullish cup and handle, you'd want to see it break that previous high that we hit here in earlier June. So that might be something to keep an eye on going forward. However, I don't know, Randy, in terms of, it looks like they're not going to be closing down the economy, and it looks like air travel is going to continue to pick up. So that's going to be something to keep an eye on, especially here. Randy, I think you tweeted out earlier about, our governor and his policy about face masks and everything. He's kind of confronted with, okay, do I put on those restrictions now? And we're running into, I think, all-time daily reported cases here. Is that right?
Yeah, so he, like a lot of others, were originally saying, look, we don't want to be too restrictive. We don't want to tell people what they have to do, and they don't have to wear face masks if they don't want to. But now that he's seeing, thousands of new cases every single day, which is pretty haunting when you think about it. Granted, Texas is the second largest state in the country from a population standpoint, but that's still a lot of cases. And I had been of the belief for many months, ever since really this thing started, that looking at the data on a what I've been doing each week and I do this in my weekly outlook. I've done that for about the last, I think, 10 or 12 weeks. Is I track not only the individual country data, but also the individual like the top 15 states in the U.S. And then I break it down on a per capita basis, because really looking at absolute numbers of cases and deaths is of no value at all, because a state like Wyoming has like 2 million people, and a state like Texas has like 100 million people. So it's really of no value to sort of look at it that way. You have to look at it on a per capita basis. And I've always been of the belief until just literally like 2 or 3 weeks ago that Texas, not only in terms of cases, and also deaths, have on a per capita basis has been way, way below almost every other state out there. And I knew that just couldn't be right. There's only two explanations the way I see it. One, we weren't testing enough, which we already knew we were one of the lowest per capita testing states in the country. And two, the outbreak began on the coast. You think about where the earliest outbreaks happened. It was in Washington, it was in Oregon, it was in California, and then it hit the other coast. It was in New York, and it was in moving from the outside towards the middle. Well, look at where Texas is. It's right smack in the middle. So as those areas have hit their peak and started to decline, it's now moving its way into the middle of the country, and Texas is getting hit. Yeah, so this is the chart probably from last week, and if you look down there on Texas, so what I've done here is I've put thresholds in on this little spreadsheet, and when they're at a certain per capita rate, they turn yellow. If they're a little bit worse, they turn orange, and when they're really bad, they turn red. And you'll notice that Texas, the death rate is 0.01%, and compare that to something like New York, where it's like 4%. You can see that that's dramatically lower. I mean, it's like unbelievably lower. And same thing with the case count, right? The case count is 0.3%. And then you've got other places like Illinois and Louisiana and Maryland, where it's well over 1%. So it's been, I believe, for a long time that Texas was way under. And again, I don't know what the explanation is, except that we do know that there's reason to believe that they haven't been testing enough, and they're now probably testing a lot more. And it also, again, I think has to do with actual physical geography. We're being in the center of the state or the center of the country. It's just now hitting our borders. And I suspect, as much as I hate to say it, that those numbers are going to go up over the next few weeks. So I'll continue to track those, because I do think per capita is kind of the right way to look at all of these things.
Yeah, absolutely. So yeah, that was on the weekly blog that you put out. So let's hop into some of the activity. So last Wednesday I was on with Kevin and we were highlighting Snap. And Randy, most of the time we put a lot of warnings on, long call buying, the short-term long call buying. So here I'm just pointing out, hey, it really worked out for the call buyers. I can't just we try to be balanced in pointing out, hey, that this works out sometimes and other times it doesn't work out, and then highlight kind of why. So Snap, last Wednesday we had some unusual activity that we're on the July 2nd, 2350 calls, and the stock has just been melting higher. Momentum, heavy volume. The stock had broken out to multi-year highs. Taking a look at these calls, they were paying at that time between 22 and 30 cents for them, and today they're going for 83 to 84 cents. So basically, like
a three-bagger, right? Yeah.
Yeah, a three-bagger there. So, and hey, you would have had to hold on through each day that it was going up as it's doing that. But this is just to show, hey, that it can work out. And Randy, I think a couple of things were working for this type of a trade. Number one, it just broke out to a 3-year high. It broke this previous resistance. If you go back to this earnings here, that I thought was fairly significant. There was a fairly significant volume, so that was coming in, and a lot of these plays like Facebook, some of these, you could almost throw the social media companies into some of those stay-at-home categories, but some
Right.
Technicals, volume, unusual option volume, and then coupled with the market just seems to continue to, or especially technology, just seems to always catch a bid or move higher. It's pretty rare to get a pullback day. With those factors in play, it looks like really helped out those call buyers from last Wednesday.
Yeah, so I think it's important to point this out that clearly it is possible to make money buying long calls, and we do focus a lot on the risks, because if I remember the data properly, you don't make money very often, but it's kind of like anything else where there's a low probability. When there's low probability, when it works out, then it's typically a high payoff. And then, like we just talked about, this thing is up 300%. So it is possible. If it wasn't possible to make money, no one would ever buy them. But sometimes you do. If you time it just right, if you can get enough of a move in the right direction quick enough to offset the time value erosion, which you said these were July contracts, I think, right? That they were looking at
July 2nd, yeah, non-standard.
Okay, so not a real short term, not like a week. It's more like 2 or 3 weeks. So that helps a little bit. But still, the time erosion is still fairly high if you look at the theta, and that'll give you an idea how fast these things are going to lose value each day, even if nothing happens. That's where you get really hurt on a lot of them, is it either goes up just a tiny little bit or it doesn't go up at all, and then the time value just starts to eat away. So that one's going to lose 3 cents every day, even if the market on the stock doesn't even move. It doesn't sound like a whole lot, but if you buy something for 40 cents and you lose, say, or I guess in this case, maybe almost 4 cents a day, that's a 10% decline in value per day. That's quite a bit, actually.
Yeah, yeah, absolutely. At the time, they were going for 22 to 30 cents. So, the time decay might have been, let's just say 2.5 cents. Well, that's still
Still
10% if the
10%,
stock
yeah.
is flat. And if the stock is down, well, then watch out. You're going to, it just increases from there. So you really need to get this type of a movement if you're going to go that short term in nature. So, guys, we're just pointing this out. Certainly not to poo-poo the idea of long call buying, but just note that you need a lot of those things to work in your favor. The market has been that type of environment where momentum and these stocks that are moving up seem to continue to move up. Case in point, if you look at something like an Apple, like a Microsoft, new all-time highs today. They've been moving higher. If we go to our screeners and you were to look at the top contracts that are traded today, Randy, I saw Facebook 250s were up there, and let's see here if we can go to our screeners.
Yeah, Facebook's around 244 right now, so those aren't too far out of the money. It's not an unreasonable trade at
It's
all.
not, but yeah, you're right, and it has been moving higher there. And William, I see your question about how to screen for this type of snap activity before it goes up. So I'll walk you through that so we can just show you this is what this show is about, and the daily blog that I put out is just really getting highlighting some of this unusual activity as soon as it comes up on our radars. But yeah, Randy, let's just go for illustrative purposes, and we'll take a look here. So you can see here, for example, the 250 call. 60,000 volume, 60,000 contracts of traded hands. This is for this Friday, $7 out of the money, and we're just walking through a hypothetical example here. So in order to do a hypothetical example, let's go to our theoretical calculator here, and we're just going to get a sense, guys. So if you traded options, you know how the price moves, you know how time decay works, you know that it kind of gets accelerated as you approach that expiration date. The gamma gets kind of bigger for those around the money options. So let's just say that Facebook at 243.55, you purchase a 250 call, 115 by 116 or thereabouts. And let's just go to 1 day's past here.
So that means you're trying to forecast what would happen to this option if the stock does something by tomorrow.
Yes, that's correct. If you go 1 days into the future, and everything else remains the same. I'm not sure exactly why this guy is not updating right now. So let me see here. I wanted to give you a sense of basically the time decay that can occur there. And keep in mind the time decay, whenever we take a snapshot like this, it's a static figure. So the time decay also changes as you approach expiration. And it depends on what type of options you're talking about, how that gets affected. Okay, so here's the 250 call. Let me see here. I'm not quite sure, Randy, why this one isn't taking. I don't know if we have a connectivity problem here.
I'm not sure what are you seeing that's not taking?
Well, we've got our the theoretical value here.
Okay.
Right, and then so the days passed. When you increase the days passed, it should be adjusting that. The
I see. It's not changing when you change the value.
Right. Yeah. Which is interesting why it's not. Let's just go to the standard basic view with the theta right now. Okay, guys. So look at the 250 call. We know it's Tuesday. We're looking at Friday at the expiration at the close. It's $7 out of the money. If you buy this 110 call here, and the stock continues to move higher, for the next couple of days, or if it gaps up tomorrow, hey, you're probably going to be doing okay. If the stock stays exactly where it is tomorrow, theoretically, you lose 32 cents out of this contract, which is a third of the value. Now, it depends on how much you invest, how much dollars you invest in there, but just keep that in mind that okay, if I were to go into a long call strategy that is out of the money that expires this Friday, and the stock is flat, we're not even talking about going down, but it's flat the next day, then theoretically I can expect to lose a third of the value on that contract. So that's kind of what we want to illustrate, just kind of the danger there. Randy, any thoughts you want to talk about on these?
Yeah, no, that's absolutely right. And then the other point, of course, is looking at the delta there. If you're going to have to think about this. If the stock goes up $1 immediately, you get 23 cents value gained in your option, but you're going to lose 32 cents in time value. You'd be lucky if you broke even by tomorrow if this stock is up $1, just because the delta is not even as big as the theta. So that's why we have to look at those two things. And that's why those values are so useful, because to make money on this one, you got to have it go up so fast and so much that it more than offsets the amount of the time erosion. If just at 1 point isn't enough to do it.
Right. Yeah, that's exactly right. So meaning the theta, and then here, it is taking the price. So you can see that theoretical value is popping with an $1 increase price there. But then when you were to take that theta into consideration, yeah, Randy, you're kind of chasing that time decay because it's out of the money. If we were talking about a 235 call, for example, there may not be that much time value in it. But then if it were flat, then you wouldn't expect to take the same hit. So it's those out of the money ones. William's saying, hey, why wouldn't you sell those out of the money options? Because the time decay is therefore working in your favor. Randy, what do you think about that?
Well, you could. I mean, and that's one of the reasons why people who tend to be more successful in the longer term, generally people who sell time. That's what we call it, basically. Now, there's a couple of problems with that. One, if you own Facebook, selling those calls is very easy because it's a covered call and you just generate the income, and then you just sit and wait for them to expire or get assigned. If you don't own Facebook, now all of a sudden you've got this humongous margin requirement, because the one time you decide to sell calls when you don't own the underlying stock is going to be the day the stock jumps up $35 a share tomorrow. And then you get crushed. And all of a sudden now you've got to make delivery. You got to sell that stock to somebody for $250, only you don't own it. And now you got to go out and buy it in the market at $290, and you're going to get whacked for 30 points. So we have to hold a huge margin requirement to make sure that if that happens, you've got enough money there to cover it. So you'll have to be approved to do naked options, first of all. You have to have lots and lots of capital so that we can hold back margin requirements to do it. Because just like it's not, the probabilities are relatively low that will happen. But I always remind people, if the probability of anything is greater than 0, it can happen. And if you do it enough times, it will. And so that's what you have to keep in mind.
Yeah.
But that's one of the benefits of covered call writing, which is why so many people do it, is they own stocks that they like, they sell calls against them, and they just sit tight and let the time erosion do its thing. And that's why being short options generally works better from a theta standpoint, because time value erosion works in your favor versus when you buy it and it works against you. But generally, it's best to do it on stocks you own, or to do it with short puts on stocks you wouldn't mind owning, and then you can do it. But doing it on when you don't have the stock, or if you don't intend to own it, that's when it gets really difficult and really expensive.
Yeah, exactly. So, guys, I mean, all of this is kind of balanced in terms of a risk reward. The market's very efficient in doing that. And so, Randy, I like to think, okay, if it's all equal and everything else is, basically statistics, and the market has calculated that, and, the invisible hands have really worked out the price. At the end of the day, I think to William's point, he's saying, hey, if I sell these options, at least I'll have time decay working in my favor versus against me in the event that the underlying moves flat. So
that's right. And you have to always assume that you're right. If every piece of information that could ever possibly be known about a stock was already known, the price of that option would reflect exactly the risk reward, but it doesn't. And we don't know. I mean, you would think you're looking at this stock and you're like, hey, this thing has had 4 solid up days in a row. What's the probability that it's going to go up tomorrow? Well, one person might look at that and go, are you crazy? It's been up 4 days in a row. It's almost certainly going to go down tomorrow, because 5 for 5 is ridiculous. And another person might look at that and go, well, of course it's going to go up tomorrow. It's on a momentum run. It's been going up for 4 days in a row. Why in the world would it stop now? Well, guess what? You're both right. And that's what the market looks at.
Yeah,
no matter whether the stock's gone up 100 days in a row or down 100 days in a row, there's still the next day that it's going to be up versus down. And that's what the options market prices are reflecting. Yeah. So it's only when you feel like you've got an edge, or that you know something that someone else doesn't, or you just got a hunch. There's an old expression, this is just a joke, but just that says, if you got a hunch, bet a bunch. And what that means is basically, we were just talking about how buying an option that expires at the end of the week is pretty risky. But if you have really strong conviction, really comfortable with it, your forecast that thing's just going to the moon, then that's the one you ought to be buying, because that's the one that's going to give you the biggest bang for your buck. But you better darn well be right, or else it's also going to take your money away the fastest if you're wrong. So if you're not so sure, and I don't know about you, I tend to be right only about 2/3 of the time. And so I trade things that will make money 2/3 of the time, and then I don't lose as much when I lose on the other third. And that's kind of how it works. If you do enough of them, then it works out in the long run.
Yeah, yeah. Good points there, Randy, for sure. William, let me just show you really quick on trade. If you log into schwab.com and go to screeners under options, here's where we get that unusual activity. And you can see here on the predefined screeners, the two that I use, high-low put call volume ratio. If you click on this guy, this will show you by default the highest puts to calls. So you can see here, 26 puts to every call. And then if you click on this link here, show low put call volume ratio, these will give you the highest call to put ratio. You have to have a minimum of 100 contracts. So, you know, you could get some names that pop up where there's 200 calls trading and 0 puts.
Yeah, and you'll sometimes also find stocks that are trading for like 20 cents a share. So you kind of have to do your own weeding out of just junk in there, because there will be junk that gets in there. And there's no easy way to get it out of there.
Right. Yeah, there certainly is. And you get about 50. The other one I like to use is large increase in option volume. So this is your absolute. AstraZeneca. I don't know if we have time to talk about it today. Unusual activity on the 54 and the 55 strike. Normally, you see 1,500 contracts trade hands. Today, 51,000. Interstellar Technologies here. We're going to talk about this guy. Interesting three-legged trade that came up on the radar. 30 times average daily volume. IAC. Plug Power. They had a conference today. 12 times your average daily volume. So, William, that's basically how we find this unusual activity. Harley Davidson saw some unusual activity. We'll see what we can get to today in terms of covering some of that there.
Just one thing I want to mention, Nate, because this is the important.
Oh, yeah.
And I know you've talked about this before. You can do that, and he can do that, but the additional element that you add that he probably can't do is we also have a Bloomberg machine. And once we find out which stocks have had big moves in options like that, then we can go to the Bloomberg terminal. We can look at every single trade, every quote that took place literally every 100th of a second all day long, and see exactly when those trades took place, what price they were done at, whether they were done at the bid or ask or closer to the bid and the ask, and then we can piece them together, and that's how we can determine whether it was a buy, whether it was a sell, whether it was a multi-leg. Unfortunately, you don't have access to a Bloomberg most likely, and you can't do that. And so that's the value add that Nate puts together with his report every day, is to give you that additional piece of the puzzle that you don't have. Because the last thing we want you to do is to read more into the info you have available to you and misinterpret it because you don't have a full picture.
Yeah, no, great context there, and that's exactly what William was following up with. He said, how do you know if we're buying or selling? And yeah, we have to go to that Bloomberg terminal and find out there. So thanks for covering that, Randy. Let's see, Stephen, I'm not 100% clear on your question, but you're saying, will the retail, healthcare, and biotech be slowly going up as there are countries that have started a second wave of pandemics and the country will not be immune to that? I don't, I'll say this, Steve, what I did notice is that, biotech has been, breaking out. I believe this is all-time highs here, although that's not the best candle today. Let's take a look at healthcare. And healthcare, not so much. So really it's been biotech today. William, you were asking, where do you get the report? At the same place you can get Randy's blog. But Stephen, could I get you to follow up on that question regarding those three sectors? I wasn't 100% clear how you wanted me to cover that in regards to the pandemic that's going on. But Randy to also comment on that as well. And here, William, I'll show you real quick. If you go to schwab.com, let's do this. Go to Insights. Trading, and then you can see here today's option market update. It comes out around noon Central Time. Just check this page. You can subscribe to our email alerts. You can get that as well. And then here's Randy's weekly Traders Outlook. That's there. So just going to Insights and then Trading, and that's how you can do that. You can also do schwab.com/TOMU as well to get that. But around noon Central every day is when we have that up. Let's go to that three-legged trade, Randy. I wanted to make sure we cover this just because we don't get to talk about a lot of these unusual types of trades that go on. So let me just start with putting some of these horizontal lines so we could take a look at what this trader was doing here, this block trader. Randy, they sold about 6,200 of the 15 puts. Let me just squanch that up a little bit. Let's go here. Of these 15 puts, they then purchased the same amount of the 30 calls.
Turn off your moving averages so that just click on those so they disappear. So because I think it'll be easier to see that if you do that. That'll make it because it'll be less clear. There you go.
Yeah, I know, it looks a little bit like mad scientist here. Okay.
A spaghetti bowl is what it looks like to me. But.
Yeah, exactly. Okay. Yeah. All right. So we'll go to. So here's what they did, Randy. Sold the 15s 6,200 times, purchased the 30s 6,200 times, and sold double of the 45s. So that would be what 12,000, or was actually what was it 6275.
Yes.
So that means that there were 12,550 of the 45 calls. They sold double of it. Net.
The bottom one's a put now. So just to clarify, the 15s that they sold were puts, not calls. The other two above were calls, correct? Right.
Yes, that's correct. Yeah. Thanks.
So if you sell the puts, then you're saying you don't believe it's going to probably go below 15, right?
Correct. Mm-hmm. And it looks like that this, I mean, if this was just a one by one, this would be a risk reversal. Your risk reversal would be selling the 15s, buying the 30s, and it's a risk reversal call spread. So you would then sell those 45s to help fund the cost of those 30 calls. However, the block traders sold double the amount of the 45 calls, and net they brought in a 9-cent credit.
Right, so it's a neat trade. I mean, it's complicated, but it's neat because essentially this guy, I mean, when I look at that trade, the first thing I think is, well, he's pretty sure it's going to go above 30, but he's really sure it's not going to go above 45, right?
Mm-hmm. Correct. And it's also, yeah, so that's a good point, Randy. Let's talk about what this implies. Block trader saying, I'm comfortable being long ITCI below 15. I believe it's going to be above 30. And somewhere in this zone, the best case scenario is it closes exactly at 45. And I really don't, I'm still okay if it goes a little bit above 45. I still have a profit zone there, but the higher it goes, then I could then move into losses because I have double the contract short at the 45 strike. Randy, what I find interesting about this is that the way that this block trader set it up is that if he's wrong and it's anywhere between 15 and 45, he still gets a 9-cent credit, which comes out to $59,000.
Right, which you could call on a trade that size basically break even. I mean, it's a tiny profit, right. But basically break even. And really, if you look at that chart, I mean, to say that you are pretty confident it won't go above 45, well, it's never been above 45 that I can see, or at least hasn't in the last year, right? So that's not an unreasonable assumption, unless some crazy good news comes out that no one expected. But it's neat.
They do have earnings on early August, so this does capture earnings.
Okay, so I would think that if I was going to do a trade like this, I would have gone back at least 4 consecutive quarters and looked at what the stock did on earnings announcements. So some stocks have a tendency to jump up every time they have an earnings announcement and then trickle off. There was a stock I was looking at the other day that I used to own that I was thinking about getting into again. I won't name it. But I looked at the last 6 earnings reports. Every single time it announces earnings, the stock drops down a point or two, and then slowly rises back up. So I thought, well, I'd be stupid to buy this thing right now. I'll wait until earnings. And the day it announces and it takes that dip, that's when I'll buy it because it has consistently always recovered from a sharp drop. So I would look at this stock to see the same thing. If I could see that even over the last several consecutive earnings reports, it didn't go above that level, then that makes sense.
Yeah, it's and we'll take a look at that real quick just to get an eye. This stock sticks out to me. I think they got a drug approved and they announced the pricing. I think the drug got approved back here. I think after that they announced the pricing. The pricing wasn't as robust. Randy, to your points, here's some of those earnings announcements. Keep in mind, guys, I did not see if this company has any other FDA reviews or announcements or anything like that going on. The implied volatility here is running pretty hot. So it's possible that there could be some other type of review or something related, pricing. So you might want to do some due diligence if
Most
you're going to be
definitely.
looking at this stock. Yeah.
Can you
But
zoom in on that one spike right there where the price goes right up to that top line? Because I think that's an interesting little story right there in the middle of your chart there, where the stock
yeah,
at the
I
top.
believe this is when they had the FDA approved. I forget exactly what type of drug it was.
Yeah.
Um,
So what I was going to say is that this is a good example of how a sophisticated options trader will oftentimes use either a support or a resistance line to
mhm.
decide which strike price to use. Oftentimes the question comes up, well, hey, I like this stock. I think it's going to go up, but how do I know which strike to pick? Oftentimes technical analysis or previous levels of support or resistance can be used. Why would you think this guy would choose to sell the 45 being that hard stop where he says, I don't think there's any chance it's going above that? Where did he come up with 45? Why was that the ideal number? My answer would be, looking back here, even when we got a big giant move on a big positive news story, it stopped right at 45. And he's saying there's a good reason to believe that it probably will do the same thing again, simply because it did it before. Basic common resistance level. So I think that's pretty
Yeah.
fascinating because this guy clearly, I mean, anyone who does a trade this size, that's this complex with three legs, clearly knows what he's doing. I should say he, her, whatever, either one.
Yeah.
Point being, but that's how you would oftentimes, when you can't decide what to use as a strike price, typical technical analysis can be very useful in that case.
Yeah, really good eye there, Randy, and I agree. That makes a lot of sense that 45 would be selected there. Stock kind of drifted lower from there. You would imagine with this big volume spike that could potentially be that area where there might be some stalling, some quicksand if the stock were to actually get up to that level, which would then be beneficial to a short 2x45 strike there. So good call. I like your eyes there. Another stock that we saw some unusual activity, WW International, formerly Weight Watchers. Randy, a little bit interesting here, just some unusual activity on the call side that was coming up 12 to 1. They've got a conference tomorrow, and so that's the only reason that I bring that one up, because you get, not just the unusual call activity and not just the unusual volume. They're really going after the July, you can see it here, 17th, 35 strike. That's pretty far out of the money, but they've got a conference at 10 a.m. Eastern, so that's kind of interesting.
Yeah, and
A
this is
lending,
also another one of those names that, like some of the gaming companies, like some of the fitness club companies, that's got a story that sort of ties into some extent with this stay-at-home mode that we're all kind of in. I hear stories all the time, jokingly, about people gaining their COVID-19, meaning 19 pounds, because they've been stuck at home with the refrigerators right around the corner, and that when we all get ready to get back to work, whenever that might be, they're probably going, and people are comfortable going places, or maybe they're already starting to do that because they're seeing that they're gaining weight. And I don't know if Weight Watchers is one of these companies that you can order that will keep you from putting on more weight. So I'm not saying that's a buy or sell, but I mean that's a story that relates to this whole thing that's going on relating to the virus and the stay at home and working at home, telecommuting and all that.
Yeah, no, good call, Randy. Again, that's this gap up right here. I remember writing about it. I believe that was last week that they reported that increase in membership, and the stock gapped up nicely. Came back down to fill the gap. Looks like it's finding some support around the 100-day. So yeah, good call. Steven saying real quick, countries have shown second wave of pandemics like China and South Korea. Some parts of UK showed fear on a second wave, and there's panic buying groceries. Therefore, I'm thinking if that's the case in general, and that affects U.S. sooner, will the stocks and options on the retail, healthcare, and biotech sectors be more in demand within the next few months, as this will push up the prices and potentially volatility? I don't know. What do you think of that thesis from Stephen, Randy?
Yeah, so I mean, I think what he's talking about is if we look at what moved higher during wave one, and all of a sudden we get a wave two that maybe some people anticipated and some didn't, will we see similar trends? I think there's a possibility of that. I think it will be more moderate than the first one. I don't think we're going to get a 38% decline in 3 weeks into the bear market like we got, because first of all, we're not starting at an all-time high, and second of all, we've all seen this movie before. So we know the plot, and so generally it'll be a little bit more moderated. But one thing I do think is important, we've talked about this in a number of other different venues, is that biotech, and in fact, I was on a meeting today where we were just looking at the extremely long list of companies in biotech and pharmaceuticals that are working on the variety of different treatments, therapeutics, potential vaccines related to this virus. It's huge. It's a gigantic list. We don't know when or if any of them will work, but it's a long list. It's a lot of companies. But one thing that is pretty consistent about this, and most of us that do research are of the same mindset, that it's the companies involved in this. Even if you happen to be the company who designs the best therapeutic or the best vaccine, will make a ton of money on it. And the reason for that is just simply because there'll be so much political pressure to do the right thing and just take care of everybody at cost. I don't think there will be huge profits earned from any company who happens to have effective therapeutics, an effective vaccine. Now, we're not expecting them to lose money, but ultimately there'll be a lot of pressure on those companies to save the world and do it at cost. So there might not be a lot of profit there. Now, that does not mean that people won't buy those stocks, because there will be a lot of goodwill and a lot of positive PR for those companies, and their brand image will go up dramatically, not only because they developed it, but also because they were generous enough to do it at cost. And so it might work out in that sense. But as far as actual true bottom line impact, it may be relatively small, if at all, for anyone that does it. But there again, you've got a lot of companies involved in this, and who actually ends up being the one that, finds the golden egg, I don't know.
Yeah, that's a good point. I know it's certainly, there's been, a lot of focus, a lot of tension, a lot of dollars going towards that. Speaking of another company that's kind of in that realm, Inovio, they've been in the news a couple times with that, and today they are in the news again. They got a Department of Defense grant here, $71 million. Stock is up, Randy. The only reason I'm bringing it up, just unusual implied volatility. This is about unusual, call activity, put activity, implied volatility. Randy, when you see an IV spike like this, so it's from 177 to 242, not specific to this stock, but does that raise your eyebrow any? Do you look to do any kind of thing with options there? Do you look to sell any of that implied volatility? Does it interest you, or?
Well, it's always a little curious when you see a price go up and volatility go up at the same time. You don't get that very often. You oftentimes will get that, just before an earnings report is when a volatility will go up. But generally, even though volatility in theory is a non-directional measure, in the marketplace it tends to be pretty directional, and it tends to be inversely related to price. So when you get a spike up in price, oftentimes you will see volatility fall back off. So what I would be expecting here, and again, I'm just using this as an example, is that because we got a big price spike, because of potentially positive news, or at least a news that the market has interpreted as positive, it's likely that you'll see that volatility come back down, because it's old news now. So yes, there could very well be opportunities to sell the vol, but keep in mind, if you own the stock, maybe this is an ideal time to sell some covered calls on it, because you can get paid a little bit more for them. But you'd be taking an enormous risk if you sold calls on it without owning it. Likewise, if you were potentially wanting to buy this stock at a lower price, maybe this is a time you could sell a put underneath it, because you'll get paid a little bit more for that. And obviously there is some upside momentum on this thing. But this again, this is high risk, and not because I know that much about this particular company, but when you see volatility levels in that range, it's very risky. Sometimes not real experienced options traders will gravitate towards stocks that have high volatility on their options. There's a reason that volatility is high, and it's because it's directly proportional to the amount of risk you're taking. So just like I was talking about with that other stock, just because this stock is up $6 today, there's still just as likely a chance that tomorrow it'll be up another 6, or that tomorrow it'll be down 6. And that volatility is reflective of that. It's not telling you that it's going to go up or that it's going to go down. It's telling you that there's a very high probability that we will get an equally outsized move in the stock tomorrow. The tough part is knowing which direction that's going to be.
Yeah, good points. And then as you can see, volatility got up into the 300s back in early March. And just to your point, Randy, seen some of these really big daily moves in the stock. So that's definitely something to be mindful of. So yes, higher implied volatility, but yes, expectations for higher moves in the near term here. So good.
Yeah, and then I can even kind of give you sort of a little idea. There's a little formula you can use. if you want to know how much the volatility on this thing is telling you, this stock is probably going to move tomorrow. So, I mean, if you take the stock price, which is, let's just call it 22, and multiply it by the implied volatility of the at the monies, which you say is 300. So in decimal form, that would be 3. And then divide that by about 19. And you end up with about a 3.5 point move. That volatility today is implying, or at least is telling you that the market's expectation is that tomorrow we will get about a 3-point move in that stock. Again, the tough part being we don't know which direction it's going to be. So that's pretty high. It's a big number. And where that 19 comes from, it's actually 19.1. But where that comes from is it's the square root of the number of days in a year. So we're taking this volatility number, which is an annualized number, and we're slicing it down into a 1-day slice. And another way to do this, as you know, Nate, and you do this all the time, is to look at a straddle. If you've got a straddle that expires, say, tomorrow, which we probably don't, but we might have one that expires on Friday, we can add up the price of those straddles and it'll be similar. This one, if it's not till Friday, might be a little high because that's still a few days away. But that's another way.
There's still some time decay in there. Yeah, for
sure.
Yeah.
So
Oh, go ahead, Randy. Sorry.
I was just going to say, so you'll get slightly different numbers that way, but generally, if it was Thursday and so what's the at the money straddle going for, about 480? Yeah. So my
about $5. Yeah.
Okay. So about $5. My formula is saying about $3.50. Keeping in mind that is taking into account the time value for Wednesday, Thursday, and Friday, which at these levels is pretty high. So pretty close. So again, the whole point of this is, yes, that's big risk. And yes, you can make a lot of money on it, but you could also if you bought this stock, I mean, you could get whacked for $3 tomorrow, and $3 on a $21 stock is a lot. That's a huge move.
Yeah. Okay. Real quick, last question, Randy. So Heaton out of Michigan, he's saying, hey, well, what are your thoughts about selling like a July 13 put for $1, which is a fairly high premium to be getting there on a $13 strike? And he's basically pegging that 50-day SMA. Your thoughts on doing a strategy on one of those, when the volatility's up, go way out of the money on the puts if you can get it?
Yeah. So here's the main thing that I like selling short puts on a stock, but there's one question you always have to ask yourself, and you got to be honest with yourself. Would you be happy owning that stock at $13? If your answer is yes, then that may not be a bad trade at all. But you got to be comfortable with the idea that I want to own it. You can't just sell an option just to collect the premium. In the case of a put, and you can go, well, shoot, I won't own it. If it goes against me, I'll just close it out. Well, then you have to say, oh, am I comfortable taking a loss on that option? Because that could happen as well. So just ask yourself the main question: would I be happy owning that thing at 13? And you're thinking, well, hey, at 21, yeah, sure, I would. But keeping in mind that it was at 13 only about a week ago. So would you still be happy if it was back down there? Because much, and then it ends up going back down to 13. You may not be as enthralled by this stock as you are right now. But that's one of the benefits of this big spike, is that you can do a strategy like that does involve a short, selling an option short so that you can collect the premium. But make sure that you can answer that question honestly, yes, before you do it.
Yeah, really good point there, Randy. Another thing you do, Heaton, if you do something like that, what I might do if I were to go to a stock and sell an out-of-the-money put that's far out of the money, if I sold it for $1, I might put a limit order to close it out at 25 or 30 cents in the hopes that, hey, if the stock moves up for a couple days, or if it hangs around this $20 level, perhaps there's a chance, maybe over the next week, that I can get out of there to 75% of that credit rather than hanging on to it all the way till the July expiration, given that we know this stock can move, and that's why the implied volatility is high. Just an
Absolutely
idea.
Right. Great advice, Nate, because you're talking about anywhere from a 50 to a 75% profit. That's pretty nice. I mean, on a stock, anybody would be, jumping to the moon to get that. So on an option, if you could get that, you should take it off. You're right.
Great. Okay. Well, Randy, thanks for all your thoughts and all your wisdom. And, we're going to have you on next week. So I look forward to that show with you as well. But thanks for joining today.
You bet.
Okay, guys, stick around. We've got Introduction to Options with Katie Johnson and Jose Rincon. So please join them for that. Thank you for joining us. We'll be back tomorrow at the same time with another Today's Option Market Recap. Bye-bye now.